listening to the Spicy Dividend. What up? It is Wednesday, March 25th, 2020. 3:03 p.m. Eastern Standard Time in lovely Pennsylvania is when I am recording this episode of the Spicy Dividend Podcast. I believe we're at episode 32. Man, these episodes are just flying along the new daily format. I hope you're enjoying the new daily format. If you are, or if you have any suggestions to how you want me to change, leave a comment down below if you're following on YouTube or if you're listening through podcasts such as Apple, Google, Spotify, wherever you may be. You can always hit me up at Twitter at DGenDividends, D-E-G-E-N Dividends on Twitter if you have any suggestions for an episode or if you have any suggestions for the podcast overall. Thank you so much for listening. Let's get into it. So, I did not see this day coming, okay? If you listened to me yesterday, I assumed it was a dead cat bounce just because, look, there was the idea of the stimulus package, and I believe that's what was spearheading the market. So in my mind, I was like, okay, if the stimulus package does come out, maybe we'll flatline. Maybe it'll go down a little bit. Maybe it'll go up a little bit. But it seemed like it was that way when the market first opened today. It opened up a little bit high or just around even, went up about 1% to 2%. Eventually, the market was actually down 1% or 2%. And right now, as I'm looking at it at 3:05 p.m., the S&P 500 is up 5%, over 1,000 points. The Dow Jones Industrial is up 6.3%, up 1,300 plus points. So obviously today has been a phenomenal day. And we have not seen back-to-back. We have not seen consecutive green days in over a month. So this is a welcoming sign. Now, a lot of people might start arguing that we've reached the bottom, right? We've reached the bottom. And I am very, very, very hesitant to say that. I don't know if we necessarily reached the bottom. I do know we're going to have more red days ahead. Typically, when you reach a bottom, you do not have these huge swings of 5 to 6%, what seems like almost every single day. When you start getting back to the 1 to 2% gains, even less so, around the 1% gains or declines, that's when you start to see a little bit of bottoming out, a little bit of leveling, a little bit return to normalcy. But tomorrow, unemployment numbers will come out, or at least, filing for unemployment, employment changes, the labor data will be coming out. This could be really ugly. Now, there's a lot of people saying this is already priced in. I do not believe this is priced in. Look, a market like this is sensitive to all news, okay? We had rumors of a finished stimulus package yesterday. Market goes up nearly double digits. Today, we sign the stimulus package. Market goes up 5 to 7%. Higher at one point today. What I'm getting at is everything is going off speculation right now. And look, the fact of the matter is everything's closed right now. At least on the East Coast and West Coast, the coast directly. Not sure how the middle of the country is doing in terms of quarantining, but everything is shut down right now. In Pennsylvania, Governor Wolf just declared we're a stay-at-home state, meaning you literally are not allowed to leave the house unless you are going to the pharmacy or going to pick up groceries. So, look, this is huge. And I'm assuming a lot of other states are like this right now, or at least they would like to think they are, unless you're a weird state like Florida who doesn't follow any rules. And I just saw that gyms in Florida just closed down. Give me a break. Gyms in PA were closed down like 2 to 3 weeks ago. So, look, some states are behind on the curve. Some states are just not, they don't have as many cases, but then again, they're probably not testing either. So it comes down to that whole point. The point is, I think we have a plethora of red days ahead of us. Now, I'm not saying that we're going to be dipping another 20 to 30% or anything by that. I think the stimulus has calmed a lot of the fears of investors. And maybe the assumption that we could possibly open around Easter. Now, I'm highly skeptical of that too. I just don't see it happening. I don't see how we're going to open stuff by Easter. I mean, a lot of the schools, at least around here, they're pretty much closed until Easter. And now you're going to say, oh, all of a sudden, boom, just like that. Flip of a switch, we're going to open up the economy again. I don't think so. It's going to be very slow. Maybe takeout in restaurants becomes a lot more prevalent. Right now, it's pretty much the only option if you want to eat restaurant food in PA is you got to do takeout. And I'm not sure with Governor Wolf's new guidelines if we're even allowed to do that because they might not be deemed essential employees. Don't know. We'll see how it plays out. I'm just sitting here eating my plant-based chicken nuggets and my smoothies. Anyway, let's cover quickly today's sells. So I know for a couple episodes I've been preaching how I cannot wait to do covered calls, selling covered calls with 100 shares in certain equities. That is not going to happen for a little bit. And I'll tell you why. It's because Fidelity's taking their sweet time approving me for options. And guess what? I got impatient. Well, I shouldn't say I got impatient. I didn't want to lose out on potential profit. So I ended up selling my 100 shares of Penn National Gaming and I ended up selling my 100 shares of Ford. Now, Ford I only bought on Monday. I bought 100 shares at $4.10 a share. Total cost basis of $4.10. Today I sold out for a total price of $551.98. So I sold Ford at $5.51, made a profit of $141.98, and this results in a 34% gain. Penn National Gaming. Now, if you follow me on Twitter, you know that I was crying about this one because I did not have a lot more cash to deploy at the time. I ended up buying various tranches around the $9 mark and also at $4.50. My total cost basis was $831.23. I ended up selling for a total price of $1,531. $700 profit resulted in an 84% gain. So I was going to sell covered call in those positions, but I thought to myself, you know what? Let's just take the profit. Who knows when I'm going to get approved for options. And guess what? Fidelity denied my application. They declined it. I just checked this 10 minutes ago. And I got declined for options. Why? I have no idea. My liquid net worth is definitely enough for thresholds for options. And whatever, I guess I answered a question they didn't like. But I mean, I only did the moderate approval for selling covered calls, not doing anything tricky like iron condors or straddles or anything like that. So I do not know what's going on. I just reapplied and said, screw it. I'm super experienced in everything, even though I'm only applying for this. So whatever. I don't have 100 shares of anything or even close to that anymore in any aspect. So excuse me a second. I'll log into work computer here. So anyway, I won't be selling covered calls for quite a bit. But hey, I'm not going to complain about a 34% profit on Ford in 2 days and an 84% profit in Penn in just under 2 weeks. It's very hard to complain about those kind of percentages. And, you know, this is what happens when you get into a bear market, quote unquote, recession. Once GDP numbers will come out, it'll be pretty much redeemed a recession. But in bear markets like this, you're going to have huge volatile swings and you're going to have some of the most historical gains, single day gains that you'll ever see in the market. So took full advantage of that. Got a little bit lucky on Penn National Gaming, buying near the dip at a $4.50 tranche. It's currently trading at $14.82. Maybe I could have held on for a little bit longer, but not taking any chances, taking the 84% and running. Very happy. Ford, didn't want to hold this one in the portfolio long anyway. This was a pure covered calls play. That's why I brought exactly 100 shares. And if I can get out with a 34% profit, don't have to worry about them anymore, then by all means, I'm going to do so. And I did that. So those were the sells today. So that I'm talking about Ford. Let's talk a little bit about dividend cuts, right? Dividend cuts are prevalent right now. And one of the worst things you hear in the market, one of the worst quotes that you hear is, this time it's different, right? Whenever you hear the words, this time it's different, a part of an experienced investor's brain is, okay, do the opposite of whether the hell they're going to tell you this. It's like if you bought stuff at the peak in February of this year and, you know, people are making their case why the market could correct, and someone comes out and say, no, this time it's different, blah, blah, blah. Well, they got absolutely trashed. And I'm sure there's a ton of people that had the mentality that the market's just going to keep going up and up, saying this time it's different. Can I make a bold exception here? I actually think this time is different. Because this is not I mean, yes, it's financial oriented. However, it's not caused by an issue in the underlying financial markets. So you have all of this brought on by the health crisis, and something like a Darden Restaurants, right? Ticker symbol DRI. I owned a share. I actually sold it today. Made a nice 70% profit on that. Now it was only like 1.5 shares. So I'm if I come off of, like, I'm bragging here, it was like $30 gain. So, it's not, I'm not like making money here. Anyway, something like a Darden Restaurants. Now, they're going to be essentially like shut down. I mean, they have some takeout, but they're essentially going to be shut down for like 2 months. So their revenue is obviously going to suffer dramatically. So something like a dividend, and they did cut it completely, at least they suspended the first quarter dividend, something like that being cut shouldn't be too much of an alarm bell. It's just because that's just the nature of the business right now. So normally, let's say we're talking like 2 years ago, right? We're in the prime of the bear market. Prime of the bull market. Everything's looking great. Nothing really daunting on the horizon. 2 years after Trump got elected, so nothing big is happening. Let's just say you had a company cut their dividend at that point. Then there's a bunch of red flags going out, right? Because if the market is extremely healthy, the economy is extremely healthy, GDP's on the rise, and the American consumer has a high confidence and they're doing a lot of discretionary shopping, if your company is cutting the dividend, then it could be seen as a bad omen. Because if you're not thriving during a bull market, how are you going to thrive during a bear market? So with these situations, it almost makes sense to cut the dividend. So this is where a distinction between a total return investor and a dividend investor comes into play. Because if you were holding something like a Darden Restaurants, they just cut their dividend, at least for a quarter, or something like a Cracker Barrel just cut their dividend entirely. That happened yesterday. Something like a Delta Airlines, which I am a buyer of right now, a holder of. Delta Airlines cut their dividend for the unknown foreseeable future. If you're a dividend investor, and strictly a dividend investor, you might freak out and you might sell right away. Let's say you own Boeing. Boeing's a very popular dividend growth investing holding. What do you do in that situation? Now, if you're hell-bent on the dividend, you might sell right away. And I was definitely one of those people, at least during the bull market, where I was like, if they cut the dividend, if they cut it or reduce it, that's an automatic elimination from the portfolio. I stand by that. That's what I said, and I pretty much do agree with that. And I'm going to say the quote, this time it's different. Look, who knows how long Darden is going to suspend their dividend for? Who knows if when they do start paying the dividend again, will it be the equivalent of what the last dividend payment was? These are unknowns. And if you're a dividend investor, it could be quite scary. If you're a total return investor, this is a little different because you're not blinded by the dividend and the dividend only. And that's kind of why I got into Ford for the covered calls. Now, I'm not a huge fan of Ford. However, I saw it as a really good opportunity. Once they cut their dividend, it's like, okay, you're going to get all the people who had faith in their really high dividend yield sell. And it did. Ford went all the way down to $4. And in my mind, I'm like, okay, I understand they cut the dividend. That was kind of like a dividend play, Ford, but it's undervalued, period. And if you are strictly going for the dividends, you don't care if it's undervalued if they don't pay a dividend. That's kind of the issue I see. I saw Delta Airlines as extremely undervalued. I bought Darden after they cut the dividend because they were extremely undervalued. So if you're a total return investor, it doesn't really matter. If you're a dividend investor, you have to kind of make a hard decision. Is that, do you believe that the business is just temporarily affected, or is this something permanent and they might not bring back the dividend? It depends what you're using the dividend income for. If you're a retiree and you need the dividend income to sustain your lifestyle, then it might be a little bit more cut and dry. They cut the dividend, you cut the position out of your portfolio. However, if you are young, like me, I just turned 29 on Sunday. If you are young and you're just holding dividend growth stocks just because for the yield on cost purposes, it's not the end of the world to wait it out. You could be pleasantly surprised that maybe in Q3 of this year, Darden Restaurants just restores the dividend. And you could have bought at an extremely low price, but you were too worried because, they cut the dividend, or, you stopped buying because they cut the dividend, or you sold a lot. You can be patient and, it could just return to normal. It depends how strict you are in your dividend policies for your own portfolio. So let me know down in the comments below or leave me feedback on Twitter. Let's say you owned like a Boeing. Did you cut the position completely? Are you waiting it out? Are you buying more at low prices? Let me know what your thoughts are, because this is a really interesting topic, because I honestly do believe this time is different than, say, a company that cut its dividend while in the prime of a bull market. This is a bear market. We have a huge act of God circumstance, if you will, that, it's not the business's fault. It's not the underlying business structure's fault. So let me know what you think. Here, that's what I think. You just got to make really tough decisions. And I ended up, even though I still am a dividend investor, I promise you, no matter how much shit I do, I will always be a dividend investor at heart. The spicy dividend name will remain. Degenerate dividends will remain. There will always be a divvy in there somewhere. So you just have to make really tough decisions. I decided total return's not going to hurt me if I go for some total return. Go for some cheap prices right now, stuff that's oversold. Not too concerned about the dividend at this point in time. Later on in life, I will be way more concerned with the dividend. Right now, dividend's a nice bonus, but it's not going to dictate what I'm buying in this type of environment. If I cared solely about the dividend and only about the dividend, I would have never in my wildest dreams bought Penn. I was able to buy a tranche of Penn at $4.50, sell it for $15.10 today. Never in my wildest dreams would I imagine an 84% gain in less than 2 weeks, and it would have never been possible if I just immediately crossed it off because it never paid a dividend in its life. So that's today's episode, March 25th. Hope it gave you something to think about. I think it was a very interesting episode. I will see everyone tomorrow, Thursday.